Welcome back to Investing Talk Podcast.
Today we're looking at New Fortress Energy.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis.
Okay, so New Fortress Energy. At its core, what kind of company are we actually looking at here?
It's an integrated gas-to-power energy infrastructure company. And that integrated part is really the key.
Meaning they don't just, buy and sell gas. They control the whole process.
Exactly. They handle the entire stack from procuring the natural gas to liquefaction, shipping, and then finally power generation on the other end.
And their focus is mostly on emerging markets, right? I see Brazil and Mexico mentioned a lot.
That's their strategic focus. They build out this critical infrastructure in places that desperately need reliable power. And that's where you see this massive potential for long-term growth.
But that's where this story gets so interesting because it's really a tale of two extremes, isn't it?
It's the most extreme dichotomy I've seen in a while. You have this huge operational opportunity on one side and on the other, an almost existential financial threat.
You can really see that conflict in the numbers. I mean, they beat revenue forecasts recently, hitting what, $679 million? That's real growth.
It is, but that growth is just getting drowned out by the debt. If you look at the trailing 12 months, they posted a net loss of over $1 billion. And even with that revenue beat, their adjusted EBITDA was actually negative in Q2 of 2025.
So the money coming in isn't enough to cover the costs, especially the financing costs. That brings us squarely to the bear case.
And the bear case starts and ends with that debt, the sheer size of it.
Let's talk about the raw numbers. Just how bad is it?
The total reported debt is sitting north of $9 billion.
Wow.
Yeah. And for a company of this scale, that has immense consequences. Their annual interest expenses alone are around $900 million.
Just to service the debt, almost $1 billion before you even think about profit.
Right. And that, of course, blows up their leverage ratio.
What are analysts projecting for that ratio? And what does it really mean for their ability to manage this?
The projections are, well, they're not good. It's expected to exceed 15 times through 2027.
15. And just for context, a stable company in this sector would be where?
You'd want to see something in the, 3 to 5 times range. 15 times tells you their current earnings are just a tiny fraction of what's needed to handle that debt. It means they are completely reliant on future growth and, more importantly, a successful restructuring.
And we saw the real-world consequences of that last year. They actually missed interest payments.
That was the trigger. They defaulted on I believe, $163.8 million interest payment. And even though it was temporary, the rating agencies acted immediately.
That's when S&P and Fitch came in.
S&P downgraded them to SD, which stands for selective default. Fitch followed with an RD, or restricted default.
And for anyone listening, what's the actual impact of getting hit with a selective default classification?
It's incredibly damaging. It basically shuts you off from most traditional capital markets. It signals extreme financial distress. And worse, these technical defaults often trigger something called cross-acceleration clauses.
And that's the real poison pill.
Yeah.
Those clauses are what wrecked their short-term liquidity, right?
Absolutely. Cross-acceleration meant their other creditors could suddenly demand immediate repayment. So their current debt money due now, it surged from about $500 million to nearly $6.6 billion overnight.
So you've got billions of dollars suddenly due immediately.
And that's what forced them in their official Q3 2025 10Q filing to disclose that there was, and this is the direct quote, substantial doubt about the company's ability to continue as a going concern.
I mean, that's the single most serious statement management can make about solvency. It's a huge red flag.
It is. And the liquidity ratios from that period are just... they're shocking. A prick ratio of 0.15.
Explain that. What does 0.15 actually mean?
It means for every dollar of debt they owe in the short term, they only have 15 cents of cash or equivalents to pay it.
You'd want that number to be at least 1.0.
At least. At 0.15, your working capital is gone. You can't manage day-to-day operations effectively.
With all that financial chaos, it's no surprise they got a compliance notice from Nasdaq.
Right. For delaying that same Q2 2025 filing, that's another clock ticking. They have 180 days to sort that out, or they face being delisted.
Which would be catastrophic for the stock. And on top of everything, there are lawsuits.
Multiple class action lawsuits, yeah. They allege the company misled investors about the projections for their fast LNG technology, basically saying the rollout and capabilities were, well, significantly overstated.
So you've got crushing debt, a default, regulatory risk, and legal challenges. That is a heavy, heavy bear case.
It's about as heavy as it gets.
So the big question is, why is anyone still holding this? Why do institutional investors own over 58%? It has to be the bull case, the belief that the assets are just too valuable to ignore.
Exactly. The bull thesis is that these assets are too strategic, too essential to the energy systems where they operate to just fail. It all comes back to their competitive moat.
Which is that integrated gas-to-power model we started with.
Yes. By controlling that whole chain, they create extremely high switching costs for their customers. If you're a national utility in Brazil and New Fortress is your only reliable source of gas and power, you are locked in for decades.
And the key to that whole strategy is their proprietary tech, fast LNG. This isn't just a buzzword, it's a real operational advantage.
It's the accelerator. A traditional LNG terminal can take, 4, 5, even 6 years to build. Fast
Mhm.
LNG uses modular equipment on ships or floating structures.
So it shrinks the build time dramatically.
From 5 years down to a potential 12 to 18 months, that speed lets them get into markets and secure contracts years ahead of the competition.
And it's not just a theory anymore. They've proven it works.
We have proof of concept. The first cargo of Fast LNG just sailed from their facility in Altamira, Mexico. That's a huge milestone. It shows the tech is real and producing.
So where are these assets expected to generate the cash to actually fight back against that debt?
The big focus is Brazil. It's estimated to drive about 30% of their EBITDA from 2025 through 2027. They have major power plants there, like Barcarena and Portocém, and floating terminals, locking down critical import capacity.
And that operational progress is what gave them just enough leverage to secure a financial lifeline.
Right. This is where the story shifts from near collapse to a potential turnaround. They pulled off a $3 billion debt and equity transaction.
What did that involve?
It was complex. A $400 million equity offering and about $2.6 billion in new senior secured notes.
And how much actual new cash did that put in their pocket?
That's the crucial part. It provided $725 million in new capital. That cash is the bridge. It's what management says will get them to positive free cash flow in 2025.
It buys them time for the fast LNG assets to ramp up.
It's all about buying time, and part of that was negotiating with their existing creditors.
The 11th Amendment Agreement?
Yes, that was essential. It extended their credit facility maturity to March of 2026, and more importantly, it temporarily suspended those key financial covenants that they were breaching.
So they got a temporary shield from default. What did the creditors get in return?
Restrictions. The creditors basically said, we'll give you time, but you can't pay dividends, you can't make risky investments. Every dollar goes to fixing the business. It was a mutual survival pact.
Okay, so we've got this incredibly volatile situation. High-value assets versus a looming debt cliff. How has the market been reacting?
Volatility is the price of admission. The stock has been trading near its 12-month lows. I mean, the range is from under $1 to over $16.
That's wild.
It is. But we saw how sensitive it is to good news. When that debt extension was announced, the stock jumped 20% after hours. It shows the market is trading purely on solvency news.
The fundamentals are almost secondary right now. It's all about survival.
Exactly. And that belief in the long-term asset value is reflected in the analyst price targets. The median 12-month target is around $7.70.
Which, from where it's trading now, is a potential upside of several 100%. A huge multi-bagger return, but with all of that risk attached.
For sure. And technically, the stock is still in a downtrend, trading below its long-term moving averages. But that institutional ownership holding stable at over 58% tells you the big players think the long-term story is intact.
So for someone tracking this day-to-day, what are the next critical milestones to watch for?
It's all about the next couple of earnings reports. The Q3 2025 release expected in early December, and then Q4 in late January.
And investors will be hanging on every word about liquidity, cash flow, and debt negotiations.
Absolutely. And operationally, the big trigger is the timeline for getting all the FLNG assets fully online. Once those units are running at capacity, the cash flow is projected to ramp up exponentially. That's the only thing that can really outrun the debt clock.
And beyond the official reports, I'm sure the rumor mill is churning. What's the speculation out there?
There's persistent chatter, though it's unconfirmed, about strategic asset sales. Maybe selling a profitable terminal in Brazil or Mexico to raise cash quickly.
That would certainly help with the immediate crunch.
It would. There's also speculation about a debt-for-equity swap with their biggest creditors.
Which would reduce the debt load, but dilute the current shareholders.
Massively. And finally, the wild card is Puerto Rico. There's a rumor about a resolution of delayed FEMA payments that could be worth hundreds of millions of dollars. That's not in any forecasts, so if it happened, it would be a huge, unexpected, positive catalyst.
So to wrap it all up, the core idea is pretty clear. The long-term value of these integrated assets and the fast LNG tech is it's massive and defensible.
But that long-term view is completely overshadowed by this severe near-term financial risk. Investing here requires absolute conviction that they can navigate these next few months successfully.
It really is the classic high-wire act for investors. Is this restructuring just delaying the inevitable, or is it buying just enough time for those strategic assets to finally start gushing cash and pull the company out of the fire?
That inflection point, when operational success finally turns into financial solvency, that is the single thing you need to be tracking.
If you want to stay on top of that volatility and track those critical milestones, make sure you subscribe to Investing Talk podcast for all our latest analysis.